Welcome back. I'm Leelaa, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. I'm sure many of you with some cash available to invest must be considering real estate at this time. This is mainly because how the real estate prices both in the residential front and the commercial front are highly depressed after the subprime problems. While there is some recovery in the residential real estate, there are excellent bargains still available in the commercial sector, even in prime locations at this time. Now, how do you decide on the right property for you and the right price as well? When looking at commercial properties purely as an investment rather than as a partial use property for business owners, the most important factor is supply and demand. The ideal property is located in an area where vacancy is low and the space available for new developments is limited. Low supply and high demand means favorable rental rates as well as the hedge of higher rate of appreciation. The strength of the local economy of the area will also affect the value of your purchase. So, you will want to check employment rates via the Bureau of Labor Statistics along with other economic growth and strength metrics. In addition to checking the BLS website, you will also want to check out the rate at which the building permits have been issued over the past few years. This will give you an idea of how the supply will be affected by new developments. Commercial real estate listings will of course be your most valuable source. If too many buildings are on the market, either for purchase or rent, then you may need to reconsider the purchase because an increase of supply will have a dilutive effect in the market and lower overall rates. Now let us look at some common key metrics to use for assessing commercial real estate. The first of this is net operating income or NOI. The NOI of a commercial real estate property is calculated by valuing the property's first year gross operating income and then subtracting the operating expenses for the first year. You want to have a positive NOI. The second is cap rate. A real estate property's cap or capitalization rate is used to calculate the value of income producing properties. Cap rates are used to estimate the net present value of future profits or cash flow. The process is also called capitalization of earnings. Investing in commercial properties is a high risk, high reward type of real estate investing that will appeal to sophisticated investors looking for a challenge. If, however, you don't have the capital to invest in commercial properties, but you still want to participate in the upside, you do have a choice. Real estate investment trusts, or REITs, offer small-scale investors the chance to enjoy the profits of commercial investing. The managers of real estate investment trusts handle all the details of purchase, maintenance, tenants, and so on, and the investor buys a share of the REIT just like a stock. This can be done without a real estate broker, and the REITs are more liquid than actually owning a commercial property. In fact, you can even hold most REITs inside your retirement account. We will talk more about REITs in the coming episodes and how you can include them in your overall portfolio. Whether you choose to invest in commercial real estate directly or indirectly depends on how much of a challenge you want to take. Coming up next is question time. Stay tuned. Invest Wisely will be shortly back after the break. Welcome back. I'm Leelaa, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. I have a question from Mr. Nick Patel in Texas. He says, I wish to gain exposure to commercial real estate without actually buying properties. Do you have any suggestions? Yes, Mr. Patel, I have already discussed one option with you today of getting exposure to real estate market without directly investing in it. That is, investing in REITs or real estate investment trusts. When you buy a share of a REIT, you are essentially buying a physical asset with a long expected lifespan and potential for income through rent and property appreciation. When purchasing a REIT, one is not only taking a real stake in the ownership of property via increases and decreases in the value, but one is also participating in the income generated by the property as well. Real estate derivatives are another way for investors to gain exposure to the asset class without the need to buy or sell properties by replacing the exposure of the real property to the performance of a real estate return index. This allows you as an investor to reduce your upfront capital requirement and to shelter real estate portfolios on the downside while providing for the alternative risk management strategies. We welcome you to write with your questions to leelaa.investwisely@tvasiausa.com. I'm Leelaa Rao signing off for today. Until we meet again, remember, do not feel rich earning money, but invest wisely to be truly wealthy. Happy Deepavali!